All right, so we're starting the end of November. We're going to start the last month of the year, December, this week. I hope everyone had a good Thanksgiving holiday, but we're going to go into this ISM and Thursday, Friday being some pretty big numbers, potentially. ISM, the manufacturing number, 9 Central on Thursday, and the unemployment report on Friday. We'll open the trading room earlier for that. But into the last month is a holiday market type of month. December sometimes could be like August. By far the two slowest months of the year historically. So go into capital preservation mode. There was opportunity around the election. It's opportunity here and there, but don't press your frequency and your overall volume if the market isn't. We're into this grind, historic highs, and it's nice when it sells off. It becomes a little bit more two-sided. But again, it just returns back to some highs, and then you get stuck and it gets drifty, so you got to be careful and keep that powder dry. We're going to go into mid-December FOMC. They're going to raise rates a quarter point. There could be something in the statement that'll move us around, so there's opportunity in mid-December. Then it'll get slow. I'm not saying it's going to get slow right away as we head into December, but it could, and so we won't get surprised. Today I want to talk quickly about risk managers, PPP, what that means, and then profile experts, all right? And just touch on these three things and get into some work that some could do if you want. If you don't, I mean, again, if you guys worked for me, there'd be guys assigned to do certain things, but you don't. You guys work for yourselves. So you could take some of these things and run with them, or you don't have to. But let's get into what kind of this means. First of all, I want to say this came into my email. Every day I get an email from this Ralph Martson. Today's topic, and I just copied and pasted it. That's why it's a little blurry. Embrace responsibility. That is so relevant to trading because we try to avoid it, try to avoid being wrong and everything else. But he said stop hoping that someone or something, these are his words, by the way, not mine. Stop hoping that someone or something or some lucky event will rescue you from responsibility. Instead, embrace it. Embrace responsibility, feel the power of your own potential, and it's deployed. Discover how strong you are and how your strength grows with every exertion. Don't let responsibility grab you from behind. Run eagerly towards it. And this is the line that caught me. Doing the work to make it work for you. Doing the work to make it work for you, but the right work. You could rest assured pretty much that the work, the effort, the concepts, the techniques are all down the right path in this program. But doing the work to make it work for you. Put yourself in the most advantageous position by aligning yourself with responsibility. Respect and appreciate the power of responsibility, and you'll be able to handle it well. Lastly, he says, feel your purpose by putting it into action. Embrace it and live up to your highest potential. Now, I'm not saying that to kick everyone in the rear end and give everybody a rah, 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 Newt Rockney speech. I'm saying it because we drift just like the market does. We drift away from responsibility. We drift away from work ethic. We drift away from all kinds of things, and we get back to it. How soon do you get back to it? How quickly do you get back to it? How quickly do you get into wanting to share, wanting to get better, wanting to do a lot of different things that maybe you can't figure out what's going on, but embrace what's hard because when you knock it over, it becomes easier. Let me go over into some research, and this is partly research that guys could do, and it's partly about something I had thought about over the weekend. Let me turn my phone off. It's ringing like crazy. Give me 1 second, guys. All right, guys, I'm back. So what do I mean by research? A couple things. Before we get to that, this is what I thought about over the holiday weekend. Risk manager. I always remember his name was Dante, was our top risk manager at the prop firm. And he'd come out, and he wasn't a grim reaper, but he'd come out onto the floor if someone was struggling, if you were down a lot, if you were down more than, he knew when someone was down a lot more, down for this guy might not be down a lot for that guy, but he knew when you were down more than average. You had responsibility that you had to take, but you had someone watching it in case you weren't. And that's a risk manager, a real person with this whole human connection. It wasn't someone that automatically, like a broker will do, and shut you down because they want to protect their interest. They don't care as much about your money. They don't want it to get into their money. But the risk manager, he did have a little bit of, compassion, because it was a connection. He didn't want to see someone struggle. His job was to protect the company's interests, but also the person. He'd come out and say, hey, take it easy, or what's the matter, or take a break. Very rarely did they not physically, but did they shut you down and shut your PC off. They had controls to do that. I don't remember any time it happening to anyone. But he'd come out, and there was a measure of accountability front and center, and you weren't embarrassed if the guy came out like everybody else sees it. You got to grow up and be an adult about it. You can be insecure. You can't be professional and good and consistent at trading if you're insecure. So he'd come out, and it didn't matter if you were a 6-figure, 7-figure a year trader, everyone had a visit by Dante at least a few times a year. There was always moments in a day, days in a week, in a month, throughout the year that you were going to struggle and you were going to get a visit from him. So everyone had a visit, period, when they were on the floor, every year, no matter how great you are. Don't think that only crappy traders need risk managers. Couldn't be further from the truth. PPP, what is this? Popular pivot points. I started looking at that, doing some research for you guys to try to help always find another way to look at the same thing and create advantages or an edge. So why the name of the program is The Edge, to find where other retail guys are stuck. We're the predators, not the prey. So as predators, we're always looking for better ways to pounce. And popular pivot points is what? S1, S2, R1, R2, mathematical formulas that these general basic charting packages do for people. Let them play it and get. Now, when they work, they work. When they don't work, let's be aware of them. Let's say, hey, we just ran through the daily pivot, which means if we ran through a daily pivot, and let me draw it on here, if we ran through a daily pivot, here's the daily pivot, that line right there. And if we're coming from below it and we do that, guess what? I would imagine the upside's the right side. Look for good retracements to buy. Does that make sense? Let me do a quick sound check. Someone says no sound. Does everybody else hear me? All right. Must be on him. All right. So if it's just, and don't think too hard about it. I even wrote this down because I thought to myself, where would I find, popular pivot points? And I just, in an effort to always stay simple, just simple search terms. And then it led me to the pivots, right? The high-low close divided by 3 is how they come up with pivots. And then there's some standard deviation from there. I think do the S1s and 2s. There's not going to be millionaire traders out of this concept alone, but it could help in a setup such as you got these retail idiots stuck. You got to start thinking like that. Do you want to be the deer or do you want to be the hunter? Even if you don't like guns and you don't like killing things, you'd still rather be the guy with the gun, wouldn't you? I'm sure you would. So you want to be the guy with the gun and let the deer run through, and now you know where they're trapped and the upside's the right side. Why? Because if a pivot point is supposed to be resistance, then you probably have a lot of those retail guys selling it. They don't know what to do when they're wrong, and when it doesn't give them a chance to get out, they're the baby birds that keep it buoyant and probably keep us heading north to the upside. I think today 0.2 as soon as we got 0.2, we stayed bullish, and 0.2 was a pivot point. So work, I have it put on my chart, one of my charts every day, what the daily pivot's going to be. Again, I don't know how much it's going to help us, but it's not going to hurt us. I really don't think it's going to hurt us at all. And that's good. Rich brings up a good point. Although when they get blasted, it probably would give you, now, I would have to look at that. The pivots are not, he's saying the pivots a lot of times are the lines in the sand. I doubt they're going to be the alert levels because one's figured out by math and the other's figured out by congestion. But if you notice, when a line in the sand doesn't work, they run it. So it's just something to keep an eye on and see if they line up. Because there's only, the one pivot is high-low close divide. There's only one main pivot during the course of a session, and then the S1s and S2s and everything else. We don't come up with, but if they do line up the same, they're not, I probably would rather not use them, but they're not created the same. Pivots are all about math for the most part. Lines in the sand is middle congestion, and alert levels are imbalances. In fact, a lot of times, the pivots, you need a session to end from yesterday to come into today, maybe use them. Your best lines in the sand, your best alert levels, your best support resistance are going to be the near-term stuff. So just keep an eye on that and look to see if it could help you when they take out a popular area. Now, building on that, is profile experts. There are guys in this Edge program that are better than I at understanding and knowing market and volume profile. I encourage people to go out and look for anyone that does any kind of, whether I wouldn't pay for it, but any kind of free profile stuff, previews, currently for the day, what they expect to happen, and then do the opposite if it doesn't work. So alert yourself to go find a profile preview, so-called expert, and do the opposite. Not that they're wrong all the time. Maybe they're right a lot. Who cares? But when they could get a following of people, that profile has become pretty popular. I wouldn't have said this 10 years ago, but I think I could say it now. Most people will back into profile, and then they'll have big moments of, this was what I was missing. Well, it really wasn't what they were missing. But most people will think that that's what they were missing. So most people will end up following and becoming a profile guru or trader, and that's fine, but come up with a setup that doesn't, when it doesn't work, it gives you a rock solid bias the other way. What would that be for some of you profile guys? When you're coming into the day, give me an example. Think about this for a second. Give me an example of what profilers try to do in a particular day. Go back to the previous day's POC, Chris, or the previous day's close. So I'm going to read a couple of them. And when you set up a profile setup and then say it's not working without being in the trade, and then find the technique, some of the qualifiers that you've learned in this program to go the other way, to know you've got these profilers stuck. Are we on the same page with that? So Steve says, wait for one of many setups, like look below overnight low and fail. Meaning when they test overnight low, go through it by a couple ticks and fail and start going up? Perfect. So what you want to do, though, is there's a lot of times that's going to work. Usually, guys who don't know what they're doing when they have a profile set up is they'll miss a lot of the winners that worked and catch the losers when it doesn't. Does that make sense? So like they test the overnight low. Here's the overnight low. We come down to it. They go through it by a little bit and then run up and fail. You still got to find an area to buy if you're going to take advantage of it. And most profile guys will say, it worked again, but they didn't catch, they miss winners and they catch most of the losers. That's usually the problem with profile stuff. Or you take too much risk because your location sucks. You think your location's better to buy it near the low, but then you catch all the losers and then it's like you're probably better off buying a higher price after you see it fail for another leg up. But my point is, when that happens, at what moment would you say that the low didn't fail? The low actually is going to get taken out again. And if you could find that moment, you probably have enough people stuck playing it. And you don't have them stuck playing it right in that circle I just drew, but you got the idiots playing it on a second or third test because they missed it. And that's the progression of thought I want people to go through. Overnight low, failed to continue, or so you think, and then it comes back down, and then it comes back down. This is the sell moment, because what you have is profile guys that didn't play the failure there, trying to do it here and here, and they're going to wear it. So begin to walk down that path. Hopefully you understand what I'm going at. You don't want to just say, in that circle I just drew, oh, that profile thing didn't work. Well, it still could work. I mean, you don't know that yet. You need to see the failure not failing, I guess. The failure not failing. So that's one setup. Overnight low, gets taken out by just a bit and then rallies. That's a failure. Chances are you miss a lot of the ones that actually worked. That's the fallacy of profiling. So that's a good one, Steve. Zane says, single prints. If it doesn't turn and go through, great. Single prints are great, especially if they stand out. You want things that stand out, like signs in Las Vegas on the Strip or Times Square, the big blinking lights. That's what you want. Big blinking light profile levels that every profile idiot in the world are going to trade. Single print. And if it works, God bless them. Who cares? If it doesn't, we cut their heads off. Because you got a single print, and if it turns, great. Maybe you took a short there, because we're better at executing than those profile guys. But what if a single print gets knocked out, and it's a single print on the upside? Then it's the same concept of these pivots. They take it out. You know you got a lot of retail traders stuck. Does that make sense? So if you get the single print that everybody in the world wants to sell or buy, doesn't work, it's the other way. And here's another example of that, though. When you have a single print come in here and the market is trading below it, you know you probably got people looking to sell it, and they might miss it, and then they might get it. And then it's like, if you can get a third time through, not just you identified the fact that there's two highs up there, but that you have a single print even above it. Now they're going to take this thing higher. You really got buy stops above it, because you got these guys missing it probably there, missing it probably there, and saying, I'm going to get it the third time. They're going to get it the third time. All right. They're the ones that make it go up. And guess what? How many times in your career did you miss it? Would have been a winner. Miss it? Would have been a winner. I'm going to take it here, and you get your face ripped off. Now, if that's a single print, this top line here, if that's a single print, this is even a better probability, in my opinion, that they take it out. A better probability there's buy stops above. Where the retail guys are. I'm not considering profile guys retail by any means, but most of them trade like it, right? Just because you know a lot about profile doesn't mean anything to the ratio of success those would have. Whoa, he's a good trader. He must be a profiler. No, doesn't work that way. We couldn't spell profile back in the day. We had an understanding of it, and it's fine to understand, but most guys couldn't understand, didn't read profile books or anything else. Chris says, if the gap doesn't close, likely to trend in the opposite direction. Yeah, I mean, that's like if you have a gap, first of all, right? So if we close, is it if you have a gap or just above or below? Let's go off this example. Let's say we open up weak and we are below yesterday's low, which is right here, and we're below yesterday's close, which is right here, okay? And this is yesterday's low. And we open up down here. That's when I say when we open up, if we make no attempt to go up, downside is likely the right side. You still got to qualify. You can't just open up and sell. You got to wait for some time to pass, and you got to be good at then a bearish. This would be a pretty bearish indicator. They didn't close the gap. Or how about this one? How about they close the gap? They open up down there. This is the close of yesterday. They do this. What do you think they're going to do? They're going to run right through it. Same concept as a single print. You got to start thinking, not start. So I think most guys do, but continue to think about other people and what they're doing and what their worries are and what they missed and when I'm going to get it this time. Train of thought. I'm going to get it this time. That's why it should be easier and easier for you to start seeing where buy stops above and sell stops below might be, whether you trade them or not. You should be more and more, they should be more and more predictable. But then if you have a retail line in the sand that are more popular to people and it doesn't work, and you could tell, let me go over here, and you could tell that it got close a couple times. Because I'm telling you right now, having talked to retail guys again and again and again, they all try to be perfect. They want to be a DICK for a TICK. They really do. They have to sell the gap. They have to sell their price because over time, they run through all their mathematical profit. Over time, they're going to make money, right? In all their statistical formulas. So when it gets close but doesn't go through, when it gets close, doesn't go through, it's not only going to get close, it's going to go through maybe the third time. And you get better at better, but you got to think along where these guys are collected. It's popular, right? The blinking lights concept. That's the whole concept of the, you guys have heard pump and dump, right? They get everybody excited about a stock after they bought it, after they're long, right? Then the blinking lights go off in that pump and dump scheme. So you're trying to find out where they're going to get collected on a level that's just too good to be true. And it's too good to be true if more people are trading it. And more people are trading it if more people realize it exists. If it does work for them, maybe you could even trade it with them because you're better at getting in and out than they are. But if you there's always more opportunity when the herd gets stuck. You don't have to get trampled if there's no cliff by the herd, but you know when the cliff is, they're gone. And now you're thinking in the proper dynamics of what makes a market do what it does, right? Too many shorts, we go up. Too many longs, we go down. And instead of being part of the problem, you're watching the problem and you're executing as part of the solutions. What makes profitable trades profitable? But how about, give me a probability profile trade though. Isn't there a popular one where if you go into yesterday's value, one of those, go away with any gap that hasn't filled. Oh, so if the gap is up here, Steve, and we're down here, keep trying to get long. It's got to fill it. It's got to fill it. It's got to fill it. Here's another good one. In a normal profile, if you enter the value area, you should test the bottom or top of it. So if a value area high is up there, value area low is up there, then what happens? If it enters the top of it, there's a high percentage it's going to test the bottom of it. Just be aware that if it doesn't happen, where is a chance to pounce for it to leave the value area again? Using the patterns, the setups, the qualifiers to know that the profile guys are all bearish. When you see this setup, if it's highly probable when you enter value area high, you're going to go to value area low, know it, and know where these guys are then stuck. Start to assign where they might have their stops, where they're wrong, where they're stuck. So what Steve is saying is, if you have a gap that doesn't fill, you go with it to the downside. So if you open up weak and you can't fill it, look out below. And that's great. But at what moment do they fail and they've got everybody stuck? Remember, most guys aren't going to catch the move. Most guys are not going to catch a move. That's why it's able to move. And this might be the most important thing I'm going to say in this meeting is if most guys caught that move up, it wouldn't have went up. You understand? If most guys bought it here, there'd be too much selling for a market to go up. So you have to understand that most people don't catch moves, traders-wise. We could, guys who are consistent do, but guys who aren't do not catch good prices of a move. That's why the SOB was able to move. Again, if most people get long in here for an anticipated move up to there, the anticipated move wouldn't happen. Get disqualified before it started because everybody who's long inside this box are sellers to try to make money on it, and all that selling makes it hard to go up. You had to shake them out and then go. Most people don't catch moves. That's why you have to know one of the first things you talk about is the best periodicity in rotation to know when a move started. To know most people didn't catch that move and to understand where a good pullback is to maybe take advantage of that move, but then where guys are going to get long late. That's the fade. You get a move that goes up, you don't necessarily know if it's going to stop there or there or there. Sometimes fading it turns into a fighting strategy. You got to get good at knowing when the people who wish they would have caught it down there bought it up in here. When that cluster, when the crowd finally got long because they wish they would have bought it here, that's when the bottom could be taken out. We go back to where we started. You either don't want to be long anymore, or maybe you want to get short. That's why it's important to follow price on a short time frame, even though you don't trade short time frame. You got to get down into the weeds. You might end up being someone that flies the fighter jet, the drone, might be a forward observer, but we're all going to start here in the weeds together. We'll find out who's better at doing what, and then you spread out and you kind of fall into your niche. But you're always good at knowing how to navigate on the ground, to follow when a move starts, and know that, most people, again, aren't going to catch the beginning of a move. That's why it moved. No, you can't wait for the crowds. Chris says, pure gold, most people don't catch the move, so you can't wait for the crowd. After you see the crowd, then you pounce. It's like here, what was it, last week, 2 weeks ago? Hunting season started in the Midwest. There's a lot of hunters and not a lot of deer. You're going to have trouble killing deer as one of the hunters, right? A lot of longs, it's going to be tough to get that deer to the upside. So I want to keep this short and sweet, these meetings as we move into November and December, because I want people not to struggle with trying to trade too much, but there are good things to look at, find when they don't work. And then this thing, it just hit me over the weekend. That's why I brought it up today. You have to have your own risk manager. Don't tell me it's your spouse. Don't tell me it's yourself. Find some sort of human connection for someone to say, you're not going to be, hey, it'd be nice if part of this program, had someone that was watching everybody's trades in a very confidential way to say, hey, Tim, be careful, or Jim, take it easy, right? Some intraday messaging, not to embarrass them because they'd be the only two that knew, and it'd be good. I mean, that's what we had. We had someone, we call it a God's eye, where that risk manager was looking at everybody's positions in P&L. We knew we were being watched. You have to trick your mind. You're being watched. So you don't listen, we're all going to do something stupid. But that second or third stupid thing is what kills you. The first stupid thing doesn't always hurt. But the second or third stupid thing is going to get you in trouble. Just like being married. You might get away with saying one thing stupid. It's that second thing you say back to back that gets you in trouble. So if you could eliminate that, right? If you could minimize or eliminate that second stupid trade in a row, not second loser in a row, don't get me wrong, second stupid trade in a row, third stupid trade in a row, save you a whole bunch of money. We're all going to make stupid trades, but do you have to make 3 or 4 stupid trades in a row? If you were in a real prop firm, you probably wouldn't, because you'd have a visit from the risk manager. Review is important. Most people spend too much time preparing and not enough time reviewing. You got to have a balance. I don't necessarily think you have to review your stuff every single day, but close. You probably should, but at least 3 times a week. You should pour over your trades, your ideas, your thoughts. And if you don't, that's fine. Just know that it's going to be a little harder to climb that ladder. You always are trying to eliminate the bad shots, not have the best looking shot, but eliminate the bad shot. Whether it's golf, shooting deer, or trading. And risk managers, they do their job, and that is, all right, you had a couple dumb trades. Are we going to make a third one, honestly? Or are we going to sit back and really focus on trading the market, not trading your stupid emotions or your anger or what you brought in to the office from the outside? Old prop owner said, you're always trading things from the outside. So you bring too much stuff from the outside, you're going to be trading price and fight with your wife or girlfriend or whatever. You got to leave it at the door and trade the market. You're trading the price. Don't take it personal and don't do 2 or 3 stupid things back to back to back. You guys could all attest to that. It ain't that one trade that gets you. It's that third or fourth in a row that gets you. Because by the time you get to 3 or 4, you're really doing something outside your setup. I can guarantee it. No accountability either. I guarantee what people do when they have that bad day, you don't even open up your statement. Get your statement emailed at night, I bet you don't even open it up. Let alone reviewing. The hardest time to review is when you need it. That's the problem. The hardest time to review and pour over your trades is when you actually should be doing it. So hopefully this helps some people just going over some pivot stuff. Here's what I've done on my charts is I go to a daily right in here. Man, this thing took out the highs, huh? So I go to a daily in here, and it's got all these reds and greens. The greens are support, S1s and 2s and 3s, and the reds are resistance. And then the blue is the pivot, which yesterday's pivot's not going to change. So yesterday's floor pivot, would that be 06? No. That would be Powell's talking, by the way, right now. 2209 half plus the low yesterday was what, 2198 half? .25 plus, that's funny how 2200 even. Divided by 3, 0250 essentially was today's pivot off of yesterday's high-low close divided by 3. So here's a good question that I'll answer. How do I recommend a group of 3 people helping each other just beyond talking frustration, struggle, real time? Well, I mean, there's a structured way to help each other, and then there's a sit around a table and drinking and more of an informal way. The formal way should be structured, and what we did was literally go into a conference room, had everybody who traded essentially the same markets, because you want to have it on point so everybody remembers what's being talked about. So we had equity traders, which were all stock index traders, and mostly European. It was FTSE, Eurostoxx, and DAX were the 3 main markets. And we would have a projector chart up there that we're all looking at in case we had to reference it. But it wasn't the center of our discussion. I mean, because listen, all day you're looking at domes and charts, right? So you don't have to look at a chart every time you talk about trading. Keep it human, and it'd be nice if you had a camera on someone so you could actually see them as you're talking to them. But the best way to do it, if it's just, I think 3 people is better than 2, and you don't want too many because you got people talking too much. And we had a little bell that that was my idea. I says, I can't listen to someone for 10 minutes, and no matter how much great things they had to say at a time. So we'd go around the table, right? So we'd go around the table and everybody would talk about their day and what they did. We reference the chart, then we get back to what they did and where they screwed up and what they caught and what they could have done. And we circled the charts, not the charts, we circled the run of bad trades we had. If I could have eliminated, here's why this run of bad trades. And there were some times where I would say, I had a run of bad trades here, and if I would have eliminated this, I would have had an awesome day. And then I looked and I said, but this particular run was the same trades that I took that made me my money. So what was good is that I didn't give back in this run what I made on my good run. So I didn't know that this was going to be a bad run before. I wouldn't have taken the damn thing. But through discussion, it illuminated the other guys that said, that's true. We can't eliminate bad runs because if they're consistent in what we're trying to do, that's the cost of doing business, right? You just didn't want a good run and a bad run to be upside down. So you have 3 winning trades and 3 losing trades and you're down money. You don't want that. But you would have your good runs and your bad runs. And you would say, were these losing trades, did they fit within what I wanted to do, or was there something else that I have to stop? Something that I want to look at. Was I trying to buy this area, and I ended up being stuck at the highs and I ended up being long at the highs of the consolidation and short at the lows of the consolidation. What's the matter with me? And the other thing I learned was, now we had 5 guys. Remember, we weren't all trying to learn to trade. We all were traders. So probably can have more guys when you have more guys that have been consistent and are doing it than if you have a few guys that are trying to get consistent. So then you maybe want a smaller group. But one thing I learned was from the guy who traded the worst. He sucked, and I learned the most from him. Kind of in line with the topic of this meeting, where look at what isn't working and do the opposite. When a pivot doesn't work, know that everybody was trying to sell it, and now it's going to be great support, number one. And number two, it's probably going to be real bullish if we get through it. Now, I'm not trying to sell a good popular pivot. I'm trying to buy it when it fails. That kind of approach. And I probably do that subconsciously. There's a lot of things you do subconsciously, right, as you learn it. And now the ability to explain what you're doing subconsciously has helped a lot of people. So I would literally have it like you were sitting around a conference table, but it has to be away from distractions of the market. We didn't do it with our trading monitors around us because then you wouldn't listen to what the guy was saying. You'd be looking at the market. It was in a separate room within the office, close the door, and we would sit and go around the table. And you thought about doing stupid stuff because you had to talk about it that day, so you could be damn certain that while you were trading in real time, I got to talk about this trade. Am I going to be proud about it if it's a bad loser? Yeah, because it's within my setup. So you see how that kind of could march you towards better trading and at least a little bit of accountability. But you got to be, it's not practical for everyone to have their own risk manager, obviously, right? But you have to really do your best at being your own, though. You have to know when you pay yourself a visit and say, come on, calm down. Because no matter, again, this isn't just for people struggling. This is for people. We all had a visit throughout the course of a month, at least a year. Now, you would think intuitively the guys that had the visits were crappy traders because they were losing money. No, it just goes to show you you're going to make money, lose money, make money, lose money. You want the pluses to be greater than the minuses, and you have something left over. But you're supposed to spend money at marketing, right? If you have a business, you have costs. That's what losing trades are. But if you're having losing trades that don't fit within what you're trying to do, you're really in trouble. Be consistently bad first. Consistent is better than inconsistent any day of the week. Be consistently bad than inconsistently good. We'll see you guys tomorrow or next week. Good luck. Hopefully this helped. I'll have it posted in the next couple hours to watch again.